Hey everyone, and welcome to this explainer. Today, we're diving into a genuinely fascinating approach to market analysis. We're going to see exactly how the educational framework used by advanced real estate holds up when we test it against one of the wildest economic periods in American history. If you have ever found yourself wondering how the math of long-term real estate actually works, when the economy is constantly shifting underneath your feet, well, you are in exactly the right place.
Here's a quick look at our roadmap for today. We're going to start with the education-first philosophy, jump into our 1980 mortgage experiment, break down nominal versus real dollars, explore the productive asset shift, and then wrap up by applying all of this to the markets we're navigating today.
All right, let's kick things off with our first section, the education-first philosophy. What's truly interesting here is how this concept completely flips the traditional script. Jalen Cassidy, who founded Advanced Real Estate, operates on this core thesis. Education always comes before persuasion. And the philosophy here is so simple but so powerful. It's the idea that wise real estate decisions, they don't come from high-pressure sales tactics. They don't come from manufactured urgency. They come from a deep, clear, and objective understanding of the market. The ultimate goal isn't to just sell you something. It's to leave you better informed and way more confident than you were when you started. To do this, Advanced Real Estate uses a neat 5-step cognitive framework to decode these really complex market dynamics. It's basically a toolkit. First, you observe what's actually happening out there in the real world. Then, you ask why it's happening. Third, you build out that chain of cause and effect. Next, you verify it all with hard, public data. And finally, you teach the reasoning. So let's take this exact framework and apply it directly to a historical case study, shall we?
Which brings us right into Section 2, the 1980 mortgage experiment.
Okay, so we are getting in a time machine and going back to 1980. We're going to buy a median American home, finance it for 30 years, and track that exact same mortgage all the way to 2010. And let me tell you, the baseline numbers here are wild. A median home back then was $62,200. Assuming a 20% down payment, our remaining mortgage is roughly $49,000. But grab your leg warmers for this one. The 30-year fixed rate was a staggering 13.74%. No, that is not a typo.
So I really want to burn this specific number into your memory. At 13.74%, the monthly principal and interest payment for that home is $579. Now, I know what you're thinking. In today's dollars, a $579 mortgage sounds like an absolute dream, right? But remember, context is literally everything here. Back in 1980, the median household income was only about $17,700 a year. So that $579, it represented a massive 39% of a household's income. This was incredibly expensive debt. Let's anchor ourselves to this 30-year journey. We've got our $579 payment, and here's the catch for our experiment. We are absolutely not going to refinance it. We aren't making any extra payments either. We are going to let this exact mortgage run completely untouched to see what the economy actually does to the debt over 3 decades.
Let's dive into Section 3, nominal versus real dollars.
If you take a step back and add up 30 years of this $579 payments, our buyer ended up paying nearly $159,000 in pure interest on a $49,000 loan. Emulating that Socratic questioning approach we talked about, we really have to stop and ask, was this just a terrible financial decision? How on earth can we justify paying 3 times the borrowed amount just in interest? Well, that actually leads us to a much deeper question. Were all of those interest dollars actually worth the same amount? As investors, we have got to separate nominal dollars from real dollars. The nominal $579 payment, that's the number printed on the bill, is frozen solid. But the real purchasing power of that money, it constantly shifts as the world reprices around it. Everything around the mortgage, wages, groceries, insurance, cars, they all change in price due to inflation. But the bank, they can't exactly call you up 20 years later and say, hey, we need more money because the dollar lost value. The payment stays frozen while the world reprices.
Looking at the data here, it's just incredible. In 1980, the payment demands 39% of a median income. 10 years later, in 1990, median income has risen to nearly $30,000, so that frozen $579 payment, it now only takes up 23% of the income. Fast forward to 2010,
income is pushing $50,000. That original payment now represents just 14% of the household income. Adjusted for inflation, sending the bank $579 in 2010 felt like sending them only $219 in 1980. The nominal payment never fell, but the real economic burden absolutely plummeted.
Real estate investor Jason Hartman actually has a fantastic term for this phenomenon. He calls it inflation-induced debt destruction. Basically, it means that when you hold long-term, fixed-rate debt, the bank is receiving future dollars that are worth significantly less than the ones you originally borrowed. The debt isn't magically erased, obviously, but the real purchasing power burden of that debt is gradually destroyed by inflation.
This brings us nicely to Section 4, the productive asset shift.
Now let's switch gears a bit. What if that 1980 home wasn't just where you lived, but was actually a rental property? Guys, this completely changes the math. On one hand, we have a fixed debt burden. Our $579 principal and interest payment is frozen solid for 30 years. But on the other side of the equation, we have dynamic asset income. Over long periods of time, rents generally rise right alongside wages and inflation.
This right here is why the type of debt you hold absolutely matters. Borrowing to buy a depreciating asset, like a car for instance, is very different from using productive debt. With a rental property, the nominal income from the asset has the potential to rise over the decades, all while the real burden of the fixed debt is actively falling. You literally have an increasing income stream that's servicing a depreciating fixed obligation.
It is the ultimate trade-off. Yes, you pay a lot of interest over 30 years, for sure. But in exchange, you gain control of an asset decades before you could ever pay cash for it. You fix your cost of capital for 30 years. The real burden of your fixed debt decreases over time, while the nominal value of your asset and your rental income steadily increase. You essentially have multiple massive economic forces working directly in your favor.
And finally, Section 5, Navigating Markets Today.
The funny thing is, we don't actually need a time machine to see this in action. We literally just lived through it. Think about buyers who locked in a fixed mortgage back in 2020. By 2023, inflation had surged, and by 2026, the world had entirely repriced itself. Groceries cost more, insurance costs more, wages have shifted. But for that person holding that 2020 fixed mortgage, their principal and interest payments stayed exactly the same. The world repriced around them, but their debt did not.
This directly addresses the hesitation we hear all the time from modern buyers. I'm just waiting for interest rates to come down. And look, it's a completely understandable thought. But our 1980 experiment proves that an interest rate of nearly 14% didn't ruin the investment. Why? Because the interest rate is only one piece of a much, much larger equation. When you only obsess over the interest rate, you entirely miss what's happening to the asset, the potential income, and the purchasing power of the dollar itself.
So how do we actually evaluate if a real estate investment works today? Well, advanced real estate teaches that you have to sit down and ask these critical, highly practical questions. What am I paying today? What does the asset produce right now? Can it actually support the debt with today's numbers? Is the debt fixed, and if so, for how long? And crucially, maybe most importantly, what happens if my assumptions are dead wrong? If rents don't go up or I hit a vacancy, can I still survive it?
This brings us to a standard of safety and patience that is just vital. Refinancing is an opportunity. It shouldn't be the reason the original deal works. If you're buying an asset today thinking, well, this deal only makes sense once I refinance at a lower rate in a couple years, you are essentially making a massive bet on a future that you do not control. You have to purchase assets that survive today's environment, based strictly on today's numbers.
Ultimately, it all comes back to how you evaluate your long-term strategies. Once you truly understand how fixed debt interacts with inflation over long periods of time, you stop reacting to short-term market fears. You start looking at the actual mechanics of wealth preservation. Does the interest rate matter? Yes, absolutely. But the math of the long game, that matters so much more. So, I'm going to leave you with this final thought as you evaluate your own investments. With everything you've learned today about the true cost of debt over time, what will help you make the wisest decision for your future?